You're welcome to my channel. In the previous videos, we managed to look at the expenses, the first expenses that are allowed, the allowed deductions. So in this video, we are going to look at the expenses that are specifically allowed under the Income Tax Act. These expenses that are specifically allowed under income tax, when these are special case expenses. They are very many, and we are going to look at them one by one. We shall start with the first one, and the first one is meals, refreshment, and then entertainment. Meals, refreshment, and entertainment, they are specifically allowed. A deduction is allowed for expenditure incurred by a person in providing meals, refreshment, or entertainment in the production of income. You have to note that. Then included in gross income. So it is allowed for expenditure incurred by the person in providing meals, refreshment, and entertainment, meaning they are providing to the employees who are engaging themselves in the production of income, and when that money is included in the gross income, but only where the following conditions apply to meals and refreshment. First is that the value is included in the employment income of an employee as a benefit in kind. So if the value of the meals and refreshment provided to the employee is included in the employee's employment income, it is allowed as a deduction this side, because the other side it is taxed, it cannot be taxed in business income too. So if the value of the meal is included in the employment income of an employee as a benefit in kind, it is supposed to be allowed in business income, or excluded from employment income for having been provided to all employees on equal term basis. So if the meals and refreshments were provided, to all the employees in the organization, it is supposed to be allowed as a deduction. And if it was given to only like a specific class of employees or only one employee, and they were already taxed under employment income, which is this, then it is also allowed as a deduction. But if it was not taxed in employment income, it becomes non-allowed this side. In case it was only provided to one employee, but the meals that are provided to all employees on equal term basis, they are allowed as a deduction, meaning they are not taxed. Then B is that the person's business income includes the provision of meals, refreshment, and entertainment, and the person to whom the meals, refreshment, or entertainment have been provided have paid an arm's length consideration for them. So in case this is entertainment, so in case the business provides meals, refreshment, and then entertainment to someone who has paid for them, it is also allowed as a deduction. In case you pay so that they can be provided to you. As an employee, you pay for the meals, the refreshments, it is allowed as a deduction. So those are the exceptions when it comes to meals and refreshment, and entertainment. They are allowable deductions, but on the condition that the value is included in employment income of the employee as a benefit in kind, or it was provided to all employees on equal term basis. Then secondly, if the person's business income includes the provision of meals, refreshment, and entertainment, whereby the person receiving them paid for them. So there it is also allowed as a deduction, and that is meals and refreshment. Then the next one we have another specifically allowed deduction is the bad debts. Bad debts are those debts that are likely not to be paid. Yeah, you just assume that someone is likely not to pay according to the way that they be behaving. Yeah, you try everything to recover the debt, but you fail, so it becomes a bad debt. A bad debt is allowed a deduction for the amount of bad debts written off in the person's account during the year of income. So a bad debt is an allowed deduction. Yeah, but it is only allowed if the following are there. So it is only allowed only if the amount of the debt claim was included in the person's gross income in any year of income. So if that bad debt had been included in the gross income, it is supposed to be deducted. We subtract it. Yeah. Then it is only allowed if reasonable steps should have been carried out to recover the money. Like you tried everything, you sent the letters, you visited, you threatened them, you took them to court, you did everything, but they refused to pay. So it becomes an allowed deduction. Yeah. If reasonable steps have been carried out to recover the money. Then another condition for a bad debt to be allowed as a deduction is that it should be specific in nature. When you are very sure that this person, maybe Sharon, is not going to pay me, and I'm very sure that she's not going to pay, so it becomes allowed. Yeah. Then it should have supporting documentation. You should have evidence that you were really demanding those people and they just refused to pay. Then lastly is the amount of the debt claim was in respect of a loan granted to any person by a financial institution for purposes of farming, forestry, fish farming, beekeeping, animal husbandry, or similar operations. So in case a financial institution, for example, a bank or a SACCO, gave a loan to someone who was carrying out these activities, yeah, and they refused to pay back, it is allowed as a deduction for that institution. So those are some of the conditions for a bad debt to be allowed. Yeah, but a bad debt is allowed a deduction if the following are there: specific in nature, supporting documentation, when you tried everything and just failed, when the bad debt was included in the gross income. Then another specifically allowed deduction is the interest expense. Interest, these are finance costs incurred on a debt obligation acquired for generating income included in the gross income. You should not forget this part, is that the money that is either allowed or unallowed must have been included in the gross income. Yeah, so interest expense, these are finance costs incurred on debt obligations. Like when you get a loan, you're always supposed to pay it back with interest on it, and that money that you pay, it's what we call the interest expense. So interest is always on debt, right? So these are finance costs incurred on debt obligation acquired for generating income included in the gross income. And a person is allowed a deduction for interest incurred during the year of income in respect of a debt obligation to the extent that the obligation has been incurred by the person in the production of income. So this is the condition. But interest expense is it is allowed a deduction, like it is not taxed, but only to the extent that the person got the debt in order to use the money in the production of income, not when when you got the loan just to go to a particular concert or to do something that is not concerned with production of income. Yeah, but if it is related to the production of income, like when you got the loan to get more stock and other things, yeah, it is supposed to be subtracted, or it is not supposed to be taxed. It becomes allowable. Yeah. Then a debt obligation. A debt obligation includes an obligation to make a swap payment arising under a swap agreement and shares in a building society. A debt obligation is like a banja, and where there is a banja, like they give you money, and in return you also have to bring back money, but that money has to just be more than what they gave you. So a debt obligation includes an obligation to make a swap agreement. Swap is exchange. To make a swap payment arising under a swap agreement, you agree that I'll give you this money, but when you're bringing it back, you're supposed to bring it back with this interest. Yeah. And that is a debt obligation. An obligation to make a swap payment arising under a swap agreement and shares in a building society. That is an interest expense. So in summary, interest expenses are allowed only if the money that you got was incurred in the production of income, not for other things that are outside business. Yeah. Then we look at another one, which is repairs and minor capital expenditure. Repairs and minor capital expenditure. A person is allowed a deduction for expenditure incurred during the year of income for the acquisition of minor capital expenditure. Acquisition of a minor capital equipment and repair of property occupied or used by the person in the production of income included in gross income. Yeah, that income must be included in the gross income. So it becomes allowed, meaning we are supposed to subtract it. Yeah, so repairs, in case you incurred any expenses to repair the property that you acquired, or you incurred expenses to acquire a minor capital equipment, that money is allowed. It is not taxed. Okay, let's continue with it and see. Minor capital expenditure, the definition, it refers to a depreciable asset. A depreciable asset with a cost base of less than 50 currency points. One currency point is equivalent to 20,000 Ugandan shillings. Therefore, 50 currency points is 1 million. Yeah, so a depreciable asset that costs less than 1 million, it's what we call a minor capital expenditure. Any depreciable asset that costs less than 1 million, it is regarded as a minor capital expenditure. So in case you buy any asset for the business, when its value is less than 1 million, it is not supposed to be taxed. It is allowed as a deduction. You're supposed to first subtract it from the gross income. However, the asset must be in position to function in its own right and is not an individual item which forms part of the asset. The asset must be in position to function in its own right when it's a whole equipment, not just part of an asset, like, let me say, a refrigerator. Yeah, you can buy those things of ice or gas for the fridge. Yeah, it can be less than 1 million, but itself is not a minor capital expenditure. If the whole refrigerator is less than 1 million, then it becomes a minor capital expenditure. not just something that forms part of the fridge. Yeah. You get what I'm saying? In case of a truck, if the whole truck is less than 1 million, it becomes a minor capital expenditure. But if only the tires of the truck are less than 1 million, it is not a minor capital expenditure. So it must be in position to function in its own right. And it's not an individual item, which just forms part of the asset. And that is what we call minor capital equipment. So all repairs and minor capital expenditures are allowed as a deduction in that the depreciable asset is less than 1 million and it is in position to function in its own right, then less than 1 million. Those are the two conditions. Yeah, so we shall continue from there in the next video.